Have you ever looked at your bank balance and wondered, where does this money actually come from? We imagine vaults, stacks of cash, shiny coins, but modern money? It isn't printed, it's written. Banks don't create money with machines, they create it with bookkeeping. A few entries in a ledger, backed by trust. That's the invisible engine behind our entire economy. Meet Sarah. She wants a $10,000 loan to finally open her dream bakery. She heads down to her local spot, Bank A. Now, here's where our traditional understanding totally breaks down. Bank A doesn't run to its vault to grab $10,000 in cash to hand to Sarah. They don't even move it from another account. Instead, the loan officer approves the application, taps a few keys, and the bank does something really extraordinary. It simply creates a new $10,000 deposit right there in Sarah's checking account. Think about this for a moment. The bank didn't use its savings, it just wrote money into existence. As the Bank of England famously put it, banks create money by making new loans. This brand new $10,000 wasn't pulled from thin air in a harmful way. For the bank, it's a liability, what they now owe Sarah. But for Sarah, it's a brand new asset, her deposit. But the story definitely doesn't stop with Sarah's loan. That new $10,000 won't sit still for long. Sarah uses it right away to buy a huge industrial oven from her supplier, John. John, naturally, deposits that $10,000 into his own bank, Bank B. Here's where it gets interesting. Bank B has to keep a little bit of that money safe, like a required safety net, called the reserve requirement. Let's say it's just 10%. So, Bank B keeps $1,000, and guess what? It's free to loan out the remaining $9,000. Bank B loans that $9,000 to Michael for a new car. Michael spends it at the dealership. The dealership deposits that money into Bank C. Bank C keeps its 10%, $900, and loans out the remaining $8,100. Do you see the ripple? Sarah's $10,000 doesn't stay $10,000. It turns into a chain of new deposits, $10,000, then $9,000, then $8,100, expanding the money supply far beyond the original amount. That's the money multiplier, the quiet engine behind modern banking. Economists even have a simple way to estimate it. Money multiplier equals 1 divided by reserve requirement. So if banks must keep 10%, the multiplier is 10. If they must keep 25%, the multiplier drops to 4. A small rule and a massive impact on how much money flows through the economy. In the end, this whole system rests on two very human things: trust and risk. You trust that when you want your money, the bank will hand it over. And the bank bets that not everyone will ask for it at the same time. This ability to create money is incredibly powerful. Used wisely, it fuels new businesses, new homes, and economic growth. Used recklessly, it can shake the entire system, as we saw in 2008 when that thin layer of trust cracked.